It's been a particularly volatile few weeks for U.S. equities, and if you look at the broad market S&P 500, we've seen swings of at least 1% 4 times in the past 2 weeks, thanks in large part to the turmoil in Libya and those exploding energy prices. Tom Lee's the chief equity strategist for JPMorgan, and he says that the seeds of a market pullback are now being sown. Tom, welcome to InBusiness. What does this pullback look like, and when are we going to feel it?
Hi, Margaret. Yeah, we think, we still think, the primary driver markets is fundamentals, which have been very good. But pullbacks are always going to ensue because these are sort of tests of thesis. I think the recent surge in oil, this 2 standard deviation move is very likely to result in companies downwardly revising estimates sometime in the next couple of months. And I think that's going to be the seeds of a pullback. I think it's going to be a convenient excuse for those who've been struggling with higher prices. I was talking to our machinery analyst, and she thinks $10 corn is a real possibility. And I think these things are going to flow through as sort of hurting certain segments of the consumer as well.
So you're not just looking at oil, you're looking at the impact on food prices and the whole energy package adding to earnings.
Correct.
Confusion.
That's right. But of all those, oil by far is the most important. You buy a box of cereal, it's got 8 cents of food in it, so it's very small. But of course, with oil, everyone, it's about an 80% pass through oil to gasoline.
Now, in your note, you issued it on the 3rd of March. We hadn't quite touched that, 106 a barrel that we've touched today, but we had still seen oil at $100 a barrel. You said at that time, each $20 rise in oil over 3 months has an impact of $2.20 in earnings per share risk. Have you increased that given the kind of moves we've seen since the 3rd?
Well, it's, I think the duration's a really important element of this, that, for every $20 rise in oil, it's basically a 20-cent per month hit to S&P. And, if we have another $20 spike from here, then it starts to become 40 cents a month. So I think really how long this crisis lasts is going to give us an idea of the earnings impact. I'd say without question there's already damage being done to a lot of sectors. I think, autos, some consumer discretionary segments, and financials. I mean, they're all going to feel that because this recent spike is going to have some effect on earnings.
So it's more the time than it is the actual pricing. That $110 a barrel mark that we've been reporting, as many CEOs saying, is a worry point for them. That's not something that you've built into your model as the trigger for this pullback.
That's right. I mean, so it's speed of move and then duration. A gradual rise in oil prices actually is sort of coincident with rising S&P earnings because it's normally associated with global demand increases. But when you have spikes like this, which are really supply risk, right? These are supply disruptions. It's very hard for businesses to pass that through. It's very hard for consumers to necessarily adjust. And a lot of higher end consumers are going to see through this. I mean, consumer spending, from every data point we can see, has been very good at the high end. In fact, really picked up in February over January. But it's really sort of these low end consumers that are subsisting that are going to really feel the pinch.
Yeah, so what's the play off of that? The obvious move would be to avoid the consumer.
That's right. I'd say that of all the groups that we're looking at, our weakest overweight is consumer discretionary. Now, we're starting to wonder if maybe this is, if this is really the start of a downturn. But on the other hand, cyclicals, especially energy and basic materials, generally do well during spikes in oil because, one, for energy, it's obviously upward revisions. But also, it's going to be one of the few places where you won't see down revisions. We still think the right way to play this overall is to buy low PE stocks. Low PE meaning PE's below 12 times.
Price to earnings below 12 times. Wait, backtrack here for me. You just said you're beginning to wonder on the consumer front if we're at a tipping point here?
Yeah, it's a tipping point for the stocks, not for the consumer itself.
Okay.
From everything we can see, the consumer is actually strengthening. The labor reports are confirming this. But as you age a bull market, there's a point where you want to be buying industrials and tech over consumer discretionary. And consumer discretionary has been really one of the best groups so far.
So you would just say lighten up here, particularly for those that have exposure to that low-end consumer, the Walmarts, the lower income buyer?
That's right. I mean, I'd say the evidence is mounting pretty strongly.
We're back now with Tom Lee, Chief U.S. Equity Strategist for JPMorgan. He's one of the most accurate forecasters for the broad market. Tom, thanks for sticking with us through the break.
Yeah.
You're saying brace yourself for a pullback late March, early April. If you do want to wait to buy or even get into the market now, what's the safest play?
Well, and we do think there's a very good probability that we're going to go to 1250. So, I mean, it's a pullback that's going to be very painful that we're anticipating. Wow. I think the way I'd be looking at a pullback is I want to buy something that's secular growth, that's got really good downside protection. That's why we like low PE. Some things that are going to come to mind are, some of these oil names, these energy names look very attractive to us. I think selected healthcare names as well, whether it's pharmaceuticals, some of the hospitals. I think what's going to be very tough are these very popular, high momentum stocks. I think that's probably where we're going to see a lot of the de-risking take place. But I'd say if I was trying not to time a rollover here, I'd be sort of using this recent strength as a way to lighten up.
But when we were just showing the top 5 picks, particularly within energy, Newmont Mining's in your number 1 slot.
Correct, and again that makes sense because it's going to be very levered to higher commodity prices. I think the PE is again it really qualifies as a low PE stock right now, and in general, basic materials and energy don't really see significant downward revisions when you see oil spikes. Why
no food play in here?
Well, I think food producers are probably not companies that have pricing power. I think that's where you're going to see margin squeeze because you're going to be dealing with higher soft commodity prices, and now your distribution costs are getting higher because of higher energy. I think it's going to be very tough to be a staples company, if you're selling food or beverages, or even if you're selling paper.
Mm-hmm. So the record food price headline isn't enough for you to get in there because of what you're saying, that inability to really not take it on the chin for margins.
Correct. That's right.
All right. Tom, thank you so much for laying out your view.